Behind every no contact story, there's usually a boomer parent saying, I have no idea why my kid won't talk to me, and an adult child who's completely exhausted from trying to explain it. Boomers are allergic to accountability. They act like grandparent toddlers, pouting, lying, manipulating, and demanding attention the second they don't get their way. They think they're the star of everyone's story, but they ruin their own families by refusing to learn basic communication, empathy, or conflict resolution skills. We've had to be the grown-ups, explaining to our parents how to be decent humans, and that's not our job. Nobody wants to go no contact with their parents. But when the rumors get back to you that they have no idea what they did, and people are looking at you like, what's wrong with you? Take that as confirmation that you made the right choice. My mother was willing to lose me rather than owning her truth and seeking help. You don't have to maintain a relationship with boomer adult toddlers just because they're your parents. There's lots of other people out there that would be happy to love you.
Have you ever stopped to consider what happens when an entire generation refuses to let go of the reins, even as the system they built begins to crumble under its own weight? As we head into 2026, everyday costs are climbing to levels that make basic living feel like a luxury. New forms of digital tracking and centralized financial systems are rolling out at an unprecedented pace, and the people who have held power for decades show no signs of stepping aside. The real question is whether the generations carrying the burden today will keep waiting for an apology that may never come, or finally decide to chart their own course. Stay with me all the way to the end because I am going to lay out exactly why focusing on your own future, your own community, and your own wealth is the only realistic path forward and how you can start doing it right now. If this message is already hitting home, do me a solid, hit the like button, share this video with someone who needs to hear it, subscribe to the channel, and click that notification bell and select all so you never miss a single upload the moment it drops. For anyone seriously looking to protect what you have and actually grow real wealth in this environment, check out Angry's Crypto Academy, where I break down step by step how to buy, sell, and trade crypto the right way without getting wrecked. The link is right there in the description, so pause this and go click it right now. And if these videos are giving you value and keeping you sharp, you can keep the energy coming by buying me a Red Bull through the link in the description. It goes a long way. Let us talk straight about where we are as a society right now. Prices are not just rising, they are accelerating toward points that will make the next 12 to 24 months feel dramatically different from anything most of us under 50 have ever experienced. Housing costs in many major cities have already doubled or tripled in real terms over the last 2 decades when adjusted against wage growth, and the trend shows no sign of reversing. Groceries, energy, transportation, insurance, every essential category is on the same upward trajectory. Central banks continue to print money at scales that dwarf anything seen in previous generations. And the bill for that is now coming due in the form of persistent inflation that erodes purchasing power day after day. Meanwhile, wages for the majority have remained essentially flat in real terms since the 1970s for large segments of the workforce. This is not random misfortune. This is the direct result of decades of policy decisions that prioritize short term comfort for one generation while shifting the long term costs onto everyone who came after. The generation in question is the baby boomers, born roughly between 1946 and 1964. They entered adulthood during what was arguably the greatest economic expansion in human history. Post World War II, America and much of the Western world experienced unprecedented growth, low debt levels, expanding infrastructure, and a social contract that included affordable housing, secure pensions, and the expectation that each generation would do better than the one before. A single income could comfortably support a family, buy a house, two cars, annual vacations, and still leave room for savings. College was inexpensive or often free in many countries. Unions were strong, benefits were generous, and job security was the norm rather than the exception. Boomers walked into this environment as young adults and reaped the full benefits. They bought homes at prices that were a small multiple of annual salary. They locked in low fixed rate mortgages. They built careers in an era when companies still offered defined benefit pensions that guaranteed income for life. They accumulated wealth at a rate no previous generation had matched, and they did it in an intimate economy that was still expanding its productive capacity rather than simply borrowing against the future. That last point is critical. The shift began gradually but accelerated over time. Instead of continuing to invest heavily in infrastructure, research, education, and productive capacity the way earlier generations had, policy increasingly turned toward consumption financed by debt. Government borrowing exploded. Deficits became the norm rather than the exception during downturns. Social programs were expanded without corresponding long term funding mechanisms, effectively creating promises that would have to be paid by future taxpayers. Corporate practices shifted from reinvesting profits into growth and worker compensation towards stock buybacks and executive compensation, again, often financed by borrowing. Household debt soared as well, with easy credit encouraging spending beyond means. All of this created an illusion of prosperity that felt real to those living through it, but it was built on pulling forward future wealth into the present. The boomers, as the largest voting bloc for decades, supported and benefited from these policies more than any other group. They received the transfers, the tax advantages, the asset appreciation, and the lifestyle inflation while the obligations were deferred. Today, the numbers tell the story clearly. Baby boomers control the majority of financial assets in most Western countries. In the United States alone, they hold more wealth than any other generation by a wide margin, even as they represent a shrinking share of the population. Their net worth continues to rise primarily through asset appreciation in housing and equities, assets whose prices have been inflated by the same low interest rate policies and money creation that have made entry impossible for younger buyers. Meanwhile, millennials and Gen Z face the highest student debt burdens in history, the worst housing affordability in recorded data, stagnant real wages, and gig economy jobs that offer none of the security their parents took for granted. The intergenerational wealth transfer that used to flow downward has reversed in many cases, with younger adults financially supporting aging parents rather than receiving inheritances early enough to compound them. Yet, the narrative pushed by many in positions of influence, often boomers themselves, is that younger generations simply lack discipline. They spend too much on small luxuries. They do not work hard enough. They expect too much too soon. This framing ignores the structural changes entirely. It ignores the fact that the same lifestyle boomers achieved on one income now requires two incomes plus significant debt just to approach. It ignores the fact that saving for a home down payment in the 1970s took a few years for a typical family, while today it takes decades in many markets, even with dual high earners. It ignores the erosion of benefits, the shift to defined contribution retirement plans that place all market risk on the individual, the explosion of healthcare costs, and the disappearance of the stable career ladder. The gaslighting is relentless, and it serves a clear purpose: to avoid any reckoning with the reality that one generation's comfort was financed at the direct expense of the next. Now, layer on top of this the emerging infrastructure of control that is being implemented at rapid speed. Digital identification systems are being piloted and rolled out in multiple countries. Central bank digital currencies are moving from discussion to testing to implementation phases. Global standards for financial reporting and monitoring are being harmonized in ways that dramatically increase visibility into individual transactions. The stated goals are usually framed around convenience, security, inclusion, and combating illicit finance. But the practical effect is a level of centralized oversight over personal finances that has never existed before. Programmable money, expiration dates on currency, transaction limits based on behavioral criteria. These are no longer theoretical, they are being actively developed. And who is driving these initiatives? Predominantly leaders and institutions shaped by and still influenced heavily by the boomer cohort. The same generation that benefited from an era of relative financial privacy and limited government reach is now overseeing the construction of a system that removes those protections for everyone who follows. Why the urgency now? Because the old model is breaking. The debt loads have reached points where traditional tools no longer work as they once did. Interest rates cannot be cut indefinitely without destroying currency value. Pension systems in many countries are underfunded by trillions. Healthcare promises for aging populations are coming due at the exact moment the working age population is shrinking relative to retirees. The demographic inversion is real. Fewer workers supporting more retirees than at any time in modern history. The system needs new revenue sources, new compliance mechanisms, new ways to direct economic behavior. Tough times are here. The 9 to 5 is history, and the creator economy is taking over. Join Angry's Creator Academy to learn how to build a thriving online business from scratch with minimal investment. Ditch the daily grind and flourish while others falter. Plus, sign up now and get our online business blueprint free. The Academy is linked in the description below. Go check it out now. And the easiest way to achieve that is through total visibility and control over money itself. The boomers who built their wealth in an analog era are now, in their final decades of influence, locking in a digital cage for the rest of us. Will they ever acknowledge any of this? Will there be a moment of collective reflection where the generation that had everything admits that perhaps, just perhaps, they took more than their share and left the table bare? The evidence so far suggests not. Instead, we see doubling down, defensiveness, claims that everything was earned through superior work ethic while ignoring the vastly different economic playing field, dismissal of younger struggles as entitlement, continued voting patterns that protect existing benefits at all costs. The psychological reality is that admitting the scale of the transfer would require confronting uncomfortable truths about one's own life choices and legacy. Most people, when faced with that, choose comfort over honesty. My expectation, based on observing decades of this dynamic, is that the majority will carry the narrative to the end without deviation. That leaves the rest of us with a clear choice. We can continue to hope for recognition that will not come, continue to direct energy toward persuasion that falls on deaf ears, or we can accept reality and act accordingly. The practical path is to disengage from the expectation of fairness from a system that has already demonstrated its priorities. Focus instead on what you can control. Build skills that are portable and valuable in any environment. Minimize dependencies on institutions that can change rules unilaterally. Protect whatever assets you have from erosion through inflation and policy shifts. Create networks and communities that operate on mutual benefit rather than extraction. Prioritize your own financial education and sovereignty. This is not about bitterness. It is about clarity. Recognizing the situation for what it is frees you to stop wasting energy on battles that cannot be won and start winning the ones that matter. The boomers are not going to save us. They are not going to voluntarily redistribute what they have accumulated. They are not going to dismantle the control systems they are building in their final act of influence. They know exactly what is happening in most cases. They simply calculate that the consequences will fall primarily on others. Accepting that reality is the first step toward building something better for yourself and those around you. So, what does that look like in practice? It starts with ruthless prioritization. Cut expenses that do not serve long term goals. Eliminate debt that carries high interest. Build emergency reserves in forms that cannot be easily devalued. Learn how money actually works beyond the surface level narratives. Understand inflation, monetary policy, Asset classes, taxation, and compounding. Invest in assets that have historically preserved purchasing power across regimes and eras. Gold, real estate in strategic locations, productive businesses, and yes, cryptocurrencies done correctly all have roles depending on individual circumstances. The key is knowledge and discipline, not hoping someone else fixes it for you. It also means redefining success on your own terms. The old markers, home ownership by 30, marriage and kids on a set timeline, climbing a corporate ladder that may not even exist in 10 years, those are optional now. Many are choosing different paths that offer more freedom and less exposure to systemic risk. Building location independent income, prioritizing health and skills over status symbols, creating parallel systems with like minded people, walking away from obligations and expectations that only serve to extract without reciprocal benefit. This is where real power lies today, in the ability to opt out selectively while building opt in alternatives. As we move deeper into 2026 and beyond, the pressure will intensify. More people will feel the squeeze. More will wake up to the generational math. Some will respond with anger directed outward. Others will turn inward and take responsibility for their own outcomes. The second group is the one that will come out stronger. The first will remain stuck, waiting for rescue that never arrives. Let us dive deeper into what this practical shift really means, because understanding it fully is the difference between merely surviving the coming years and actually thriving despite the headwinds. As we sit here on the first day of 2026, the signs are everywhere that the economic pressures we discussed are not hypothetical anymore. They are unfolding in real time. Inflation reports from the closing months of 2025 showed persistent upward pressure on essentials, with food and energy costs leading the charge in many regions. Housing markets in major urban centers remain locked in a state of extreme unaffordability, with inventory at historic lows and prices continuing to defy gravity despite higher borrowing costs. Central banks around the world have signaled that rate cuts are limited by the risk of reigniting inflationary spirals, meaning the era of cheap debt that fueled so much of the previous decade's illusion of wealth is firmly behind us. This is the environment younger generations are navigating, one where every dollar earned buys less tomorrow than it does today, and where the rules of money itself are being rewritten by those who stand to lose the least from the changes. Consider the historical parallel to make this clearer. Throughout human history, periods of major intergenerational tension have often coincided with shifts in monetary systems or resource allocation. Take the Roman Empire in its later centuries, for example. The early empire built tremendous wealth through conquest, trade, and sound money in the form of gold and silver coinage with consistent purity. Citizens of that era enjoyed relative prosperity, public works, and a sense of upward mobility. But over time, emperors facing military costs and political pressures began debasing the currency, reducing the precious metal content while maintaining the face value. This allowed short term spending and benefits for the ruling class and their supporters, but it eroded purchasing power for everyone else. By the third century, inflation had become rampant, savings were destroyed, and the empire relied increasingly on coercion and control to extract resources. The generations living through the peak reaped the rewards, while those in the decline bore the consequences. Eventually, the system fractured, and new structures emerged from the periphery. The point is not that history repeats exactly, but that it rhymes. When one cohort extracts disproportionately through systemic means, the backlash or reconfiguration comes from those left holding the bag. Fast forward to the post World War II era, and we see a similar dynamic on a global scale. The Bretton Woods system initially tied currencies to gold, providing a measure of discipline. But as costs mounted, wars, social programs, infrastructure, the United States, as the anchor currency issuer, began running deficits and eventually severed the gold link entirely in 1971. This ushered in the fiat era, where money creation became unconstrained by physical limits. The boomer generation came of age precisely during this transition and the subsequent decades of credit expansion. They benefited from the early stages of this new system where borrowing against the future felt like free growth. Asset prices rose steadily, wages appeared strong in nominal terms, and the illusion held because the consequences were deferred. Productivity gains from earlier investments still carried the economy forward for a while. But by the 1980s and 1990s, the shift toward financialization accelerated. Manufacturing moved offshore, unions weakened, and wealth concentration began in earnest. Stock markets boomed on lower rates and buybacks. Housing became a speculative asset rather than just shelter. All of this was sustainable only as long as debt could keep growing faster than the underlying economy. Now, in 2026, we are hitting the limits of that model. Total global debt has surpassed levels that economists once considered impossible without crisis. Pension obligations in developed nations amount to tens of trillions in unfunded liabilities. Demographic shifts mean fewer workers per retiree than at any point since the systems were designed. And the response from policymakers, many still drawn from or influenced by the boomer cohort, is not to tighten belts or restructure promises, but to double down on control mechanisms. This is where digital IDs and central bank digital currencies enter the picture more concretely. Pilot programs that were experimental just a few years ago are now scaling. Several major economies have launched or are launching retail CBDCs with features that allow for direct transmission of stimulus, negative interest rates to discourage saving, or conditional spending rules. The rhetoric frames these as tools for efficiency and inclusion, but the underlying capability is unprecedented oversight. Every transaction traceable, programmable restrictions possible, and the ability to enforce compliance baked in from the start. This is not about conspiracy, it's about capability and incentive. When a system is insolvent in the traditional sense, the path of least resistance is to change the rules rather than default on promises. And the boomers, having built their wealth in a world of anonymous cash, branch banking, and limited tracking, are now overseeing the transition to something entirely different. Whether this is deliberate legacy protection or simply inertia matters less than the outcome. The result is a financial landscape where privacy is optional for the powerful but mandatory to surrender for everyone else. Younger generations, already starting from a disadvantaged position, will operate under these rules by default. Savings can be eroded not just by inflation, but by direct policy, expiration dates on balances, spending mandates, or penalties for noncompliance with whatever criteria are deemed socially beneficial at the time. This is why disengagement and self protection are not optional, they are essential. So, how do you build resilience in this environment? It starts with education, real education about how money and power intersect. Most people operate with a surface level understanding inherited from a different era. Work hard, save in a bank account, invest in index funds, buy a house, retire on Social Security and a 401k. That playbook worked beautifully for boomers because the underlying conditions supported it. Interest rates outpaced inflation for long periods. Home prices appreciated reliably. Pensions were backed by growing companies and governments. But those conditions no longer hold. Banks now pay negligible interest while inflation runs hotter. Home ownership rates for young adults are at multi decade lows. Retirement systems are shifting risk entirely to individuals just as markets become more volatile. The new playbook requires understanding monetary history, the Cantillon effect, how new money benefits those closest to the source first, and the difference between speculative assets and stores of value. One of the most powerful tools available today for preserving and growing wealth outside the traditional system is cryptocurrency, particularly when approached with discipline and knowledge. Bitcoin, for instance, emerged directly in response to the 2008 financial crisis when trust in centralized institutions hit rock bottom. Its design is elegant in its simplicity: a fixed supply of 21 million coins, decentralized verification, and no single point of control. Unlike fiat currencies, it cannot be printed at will. Unlike gold, it is divisible, portable across borders instantly, and verifiable by anyone. Over the past 15 years, it has weathered multiple cycles of boom and bust, regulatory attacks, and media dismissal, yet its network has grown stronger each time. As we enter 2026, adoption is accelerating among institutions, nations, and individuals precisely because it offers an alternative to the debasement and control trends we see in legacy systems. But cryptocurrency is not a get rich quick scheme, and anyone telling you otherwise is selling something. It requires understanding private keys, seed phrases, hardware wallets, and the importance of self custody. Never leave significant amounts on exchanges. Those are convenient for trading, but vulnerable to hacks, freezes, or regulatory seizure. Learn the difference between proof of work and proof of stake, between layer 1 protocols and layer 2 scaling solutions. Study on chain metrics to separate signal from noise. This is why resources like Angry's Crypto Academy exist, to cut through the hype and noise and provide structured, step by step guidance on entering the space safely. From setting up your first wallet to advanced strategies for hedging against inflation or generating yield without excessive risk, the foundation matters more than chasing the latest trend. Beyond crypto, diversification remains key. Physical assets like gold and silver have preserved purchasing power through centuries of monetary experiments. Strategic real estate, perhaps in undervalued or emerging areas rather than overbid urban cores, can provide utility and inflation protection. Productive skills that generate income independently of location or employer loyalty are invaluable. Starting a side business, mastering trades that cannot be easily automated, or building digital products all create optionality. The goal is multiple streams that are not all correlated to the same systemic risks. Community plays a crucial role here as well. The old model relied on large institutions, governments, corporations, banks, to provide security and opportunity. When those institutions prioritize one cohort over others or shift toward control over service, parallel networks become essential. Find like minded people who value sovereignty, mutual support, and long term thinking. Local groups focused on skill sharing, barter systems, or collective investing can buffer against centralized failures. Online communities that vet members carefully offer knowledge and opportunities that mainstream channels suppress. This is not about isolation. It's about choosing relationships that add value rather than extract it. Redefining relationships with family and obligations fits into this framework too. The traditional expectation was that younger generations support elders unconditionally while building their own futures. But when the economic math has been altered so dramatically, blind adherence to that script can mean permanent subordination. Setting boundaries, directing resources toward your own stability first, and building intergenerational equity on new terms, these are not selfish acts. They are necessary for breaking cycles. Many are discovering that true generosity flows from strength, not depletion. As 2026 progresses, expect more milestones in the control infrastructure, more countries announcing CBDC rollout timelines, more integration of digital IDs with financial access, more narratives framing cash as obsolete or suspicious. These changes will be sold as inevitable progress, but progress for whom? The answer lies in who designed the system and who benefits from its features. Meanwhile, alternatives like decentralized finance continue to mature, offering lending, borrowing, and yield without intermediaries. Privacy focused tools evolve to counter surveillance. Hard money assets appreciate as fiat confidence wanes. Those positioned early with knowledge and discipline will navigate this transition with far less friction. The psychological shift is equally important. Letting go of the expectation that the system will become fair because it should be fair frees enormous energy. Anger is natural when recognizing the scale of the transfer, but channeling it into productive action yields better results than resentment. Study the mechanics, implement the protections, build the networks. Watch as compound effects work in your favor over time. A decade from now, the landscape may look very different, with power distributed more broadly among those who opted out of dependency. This path, focusing on self sovereignty, education, and selective disengagement, is not easy. It requires consistent effort, delayed gratification, and tolerance for uncertainty. But compared to the alternative, waiting for reforms from a system incentivized against them, hoping for intergenerational justice from those who benefit from the status quo. The evidence of decades suggests that path leads to continued erosion. The empowered choice is to build your own foundation now, while options still exist. Let us examine what happens when individuals begin applying these principles in their daily lives, because the transformation is not abstract. It manifests in tangible outcomes that compound over months and years. As we move through the opening weeks of 2026, reports from major economies confirm that consumer price indices remain elevated, with year over year figures in many countries still hovering well above central bank targets. Energy markets continue to experience volatility driven by geopolitical tensions and supply constraints, pushing household bills higher at the exact moment wage negotiations in many sectors fail to keep pace. Rental markets in urban centers show vacancy rates near historic lows, translating to annual increases that outstrip income growth for the majority of tenants. Credit card debt levels across developed nations have climbed to new records as families bridge the gap between earnings and expenses. These are not isolated anomalies. They are the predictable outcome of decades of monetary expansion now colliding with supply side realities and demographic pressures. The system that delivered prosperity to one generation through leverage and deferral is now demanding payment, and the collectors are not offering flexible terms. This environment rewards those who prepare deliberately while punishing procrastination. The first step for anyone waking up to this reality is a complete audit of personal finances with brutal honesty. Track every expense for at least 3 months to identify leaks, subscriptions unused, convenience spending that adds up, insurance policies overpaying for coverage rarely needed. Cut ruthlessly. Redirect the savings immediately into high priority areas, eliminating high interest debt first, then building a liquid emergency fund equivalent to 6 to 12 months of essential expenses. Hold this reserve in forms that preserve access and value. Short term treasuries, if available in your jurisdiction, stable digital assets, or physical cash in secure storage. The goal is optionality when unexpected costs arise without resorting to predatory lending rates that have spiked in this higher interest world. Once the foundation is stable, attention turns to wealth preservation and growth outside traditional channels that are increasingly vulnerable. Equities markets in early 2026 show continued concentration in a handful of mega cap technology firms, while broader indices struggle with valuation concerns and recession signals. Bond yields offer better income than in previous years, but still lag real inflation when measured by essentials rather than official baskets. Real estate remains bifurcated. Prime locations continue appreciating on scarcity, while secondary markets face pressure from remote work shifts and affordability constraints. The common thread is that legacy assets are priced for a world of perpetual low rates and expanding credit, conditions that no longer exist. Positioning here requires caution. Avoid leverage unless margins of safety are enormous. Favor cash flowing assets over speculative appreciation, and maintain liquidity to capitalize on dislocations when they appear. This is where alternative assets become indispensable. Precious metals have performed their historical role reliably during this transition period, with gold reaching new nominal highs as investors seek refuge from currency debasement. Silver offers additional upside from industrial demand in green energy applications. Both are physical, finite, and independent of counterparty risk when held directly. Store them securely. Home safes for smaller amounts, allocated vault storage for larger positions. They are not for trading daily, but for holding through cycles. Cryptocurrencies extend this logic into the digital realm with unique advantages. Bitcoin's dominance continues to grow as nation states and corporations add it to balance sheets, recognizing its scarcity and network effects. Its halvings enforce supply reduction mathematically, creating predictable scarcity unlike any fiat system. Ethereum and select Layer 1 protocols provide utility through smart contracts and decentralized applications that are already powering real economic activity, from remittances to supply chain tracking to creator economies. The key to success in this space is methodical accumulation rather than speculation. Dollar cost average into proven assets during volatility, ignoring short term price noise. Secure your holdings with hardware wallets and multi-sig setups for larger amounts. Learn tax implications in your jurisdiction to minimize friction. Avoid overexposure to unproven projects or excessive leverage on exchanges. This disciplined approach has turned modest, consistent investments into substantial wealth for those who started early, and the window remains open in 2026 despite higher headline prices. Market cycle, corrections come, and patient participants buy those dips. Resources that teach this methodology properly are rare amid the noise of influencers chasing trends, which is precisely why structured education matters. Angry's Crypto Academy provides exactly that. Comprehensive modules walking through wallet setup, security best practices, on chain analysis, portfolio construction, and advanced topics like staking and decentralized finance without the hype. Members gain clarity that turns confusion into confidence. And the link remains in the description for anyone ready to level up. Beyond individual assets, income diversification is non negotiable. The traditional model of one employer providing security has fractured. Layoffs in technology and finance sectors throughout 2025 demonstrated how quickly stability can evaporate. Multiple income streams create resilience. Develop skills that translate across borders and platforms. Coding, digital marketing, content creation, specialized trades. Launch side ventures that start small and scale with validation. E-commerce, affiliate models, consulting based on expertise. All leverage low overhead and global reach. The internet remains the greatest equalizer, allowing individuals to build audiences and monetize knowledge directly. Platforms reward consistency and value delivery. Those who invest time now in building an online presence or niche authority position themselves for exponential returns as attention becomes the scarcest resource. Health optimization fits into this framework as critical infrastructure. Medical costs continue rising faster than general inflation, with insurance premiums reflecting that trend. Preventive measures, consistent exercise, quality nutrition, sleep discipline, stress management, reduce dependency on a system strained by aging demographics. Strength training preserves mobility into later decades. Metabolic health counters the processed food environment designed for addiction rather than nourishment. Mental resilience practices, meditation, journaling, exposure to discomfort build the psychological armor needed when external conditions challenge resolve. A body and mind operating at capacity compound every other effort. Relationships and community require intentional curation. Surround yourself with people aligned on values of self reliance and growth rather than entitlement or extraction. Mentorship flows both ways in healthy networks. Learn from those ahead while teaching those behind. Local meetups focused on practical skills, gardening, mechanics, financial literacy, build bonds that translate into real support during disruptions. Digital communities, vetted for quality, provide global connections without geographic limits. The shift from consumption focused social circles to production oriented ones accelerates progress for everyone involved. As policy developments unfold in 2026, stay informed but not consumed. Monitor central bank announcements, legislative proposals around digital currencies, regulatory shifts in asset classes. Understand the implications without emotional reaction. When CBDC pilots expand and traditional accounts begin integrating new features, having alternatives already in place removes urgency. When tax regimes adjust to capture more revenue, legal structures like trusts or international options may become relevant for higher net worth individuals. The principle remains: control what you can, adapt to what you cannot, and never build your future on assumptions of permanent rules. The broader cultural shift accompanying these changes deserves attention. Narratives that once dominated endless growth through consumption, government as ultimate provider, institutions as inherently benevolent, are losing credibility with each passing quarter. Younger cohorts increasingly reject the scripted path of debt financed education, leading to corporate employment, leading to leveraged home ownership, leading to retirement dependency. Opt out rates rise. Lower marriage and birth rates reflect rational responses to economic signals rather than moral failure. Entrepreneurship surges despite barriers. Relocation to lower cost or lower regulation jurisdictions accelerates. These are not random trends, but adaptive behaviors to a changed incentive landscape. The men walking away philosophy encapsulates this response at its core. It recognizes that many traditional obligations, provider roles without reciprocity, institutional loyalty without security, societal expectations without corresponding rewards, have become extractive rather than mutual. Walking away is not abandonment, but reallocation of finite resources, time, energy, capital. Direct them toward endeavors and relationships that compound positively. Build parallel systems that operate on consent and value exchange. The power of this approach lies in its scalability. Millions making individual choices create macro shifts without needing permission or coordination from above. Looking ahead through 2026 and beyond, the divergence will widen. One path continues hoping for systemic fixes from the same architects who created the imbalances. The other builds independence incrementally, day by day. History favors the second group. Empires decline when extraction exceeds production, but new centers emerge where incentives align with creation. Individuals positioned with knowledge, assets, skills, and networks thrive through transitions that crush the unprepared. The opportunity exists right now to join that cohort. Practical implementation starts today. Choose one area: expense tracking, skill development, asset allocation, and execute consistently. Momentum builds from small wins. Track progress monthly. Adjust as conditions evolve. Share knowledge within your circle to multiply impact. The compound effect of disciplined action over years dramatically alters trajectories. This moment in early 2026 represents both challenge and inflection point. The old model creaks under its own weight while new tools and possibilities expand rapidly. Those who recognize the shift early and act decisively gain disproportionate advantage. The alternative, waiting for external salvation, guarantees continued erosion. Choose accordingly. Let us explore the specific mechanics of building financial sovereignty in this precise moment of early 2026, because the window for positioning ahead of accelerating changes is narrowing with each policy announcement and economic report. Central banks in major economies concluded 2025 with balance sheets still bloated from years of quantitative easing, and the minutes from their latest meetings reveal a consensus that inflation remains sticky in core services and shelter components, limiting room for aggressive rate reductions. Markets have priced in only modest cuts for the year ahead, meaning borrowing costs stay elevated for households and businesses alike, squeezing margins and delaying recoveries in interest sensitive sectors like construction and automotive. Meanwhile, government debt issuance continues at record paces to fund deficits driven by entitlement spending and interest payments that now consume larger shares of budgets than defense or education in several nations. This is also the backdrop against which individuals must operate, not a temporary dip, but a structural shift where the cost of capital reflects the accumulated imbalances of prior decades. The response cannot be passive investing in broad indices with the expectation of perpetual compound growth fueled by ever expanding credit. That model thrived when demographic tailwinds supported consumption and when monetary policy could reliably engineer soft landings. Those conditions have inverted. Population pyramids in developed countries now show bulging retiree cohorts drawing down savings, while working age populations shrink in relative terms. Consumption growth slows accordingly. Corporate earnings face headwinds from higher input costs, and central banks walk a tightrope between controlling prices and avoiding recessions. Passive strategies still have a place for portions of portfolios, but they must be complemented by active hedges and uncorrelated assets that perform when traditional markets struggle. This brings us to the strategic allocation framework that prioritizes preservation first and growth second. A robust starting point divides resources into tiers: immediate liquidity for opportunities and emergencies, core holdings for long term value storage, and satellite positions for asymmetric upside. Liquidity might include high yield savings alternatives or stablecoin positions earning real yield in decentralized protocols. Rates in early 2026 often exceed traditional bank offerings after accounting for inflation erosion. Core holdings lean toward scarce assets with proven track records across monetary regimes. Bitcoin as digital gold, physical precious metals for tangibility, and perhaps farmland or timberland for productive real assets if capital allows. Satellite positions explore higher risk opportunities like select altcoins with strong fundamentals, early stage decentralized projects, or undervalued equities in sectors benefiting from technological disruption or resource scarcity. Execution requires precision. For Bitcoin specifically, accumulation strategies in 2026 benefit from understanding cycle dynamics. Post-halving periods historically deliver strong returns as supply growth slows while demand compounds through institutional adoption and network effects. Exchange-traded products have matured, allowing exposure without direct custody for conservative investors, but self custody remains superior for sovereignty. Set up cold storage properly, generate seed phrases offline, test recoveries, distribute backups geographically. Use multi signature wallets for amounts that justify added complexity. Contribute regularly, regardless of price action, rebalance annually, and resist the urge to time markets perfectly. The mathematics of scarcity are inexorable, with issuance halving every 4 years and lost coins removing supply permanently. Long term holders capture the premium as adoption spreads. Extending this to broader decentralized finance reveals opportunities that legacy systems cannot match. Lending protocols offer yields on stable assets backed by over collateralization, often outperforming bank rates without credit checks or geographic restrictions. Borrowing against crypto holdings allows access to liquidity without triggering taxable events, preserving upside exposure. Yield farming and liquidity provision reward participants for securing networks, though risks demand careful selection of audited protocols and impermanent loss mitigation. These tools democratize finance in ways that threaten centralized control, which explains the regulatory pushback intensifying in 2026. Stay ahead by understanding jurisdictional differences. Some countries embrace innovation, while others impose restrictions that create buying opportunities during fear driven sell offs. Regulatory clarity is evolving rapidly this year, with frameworks emerging that distinguish between securities and commodities, between centralized exchanges and decentralized protocols. Navigate this by focusing on assets with the strongest decentralization metrics: high node counts, geographic distribution, resistance to censorship. Avoid projects reliant on single teams or foundation that could be pressured. The trend favors protocols that anyone can run and verify, aligning with the original vision of permissionless money. Education here separates winners from casualties, as markets punish ignorance harshly. Structured learning paths cut the learning curve dramatically, covering everything from basic transactions to advanced options like wrapped assets, cross chain bridges, and privacy tools. Angry's Crypto Academy continues to deliver this depth with updated modules reflecting 2026 developments, regulatory shifts, new scaling solutions, institutional inflows. The link stays in the description for immediate access. Parallel to digital assets, building human capital yields the highest returns with the lowest correlation to market cycles. Skills compound silently but powerfully. Master proficiency in areas where demand outstrips supply: artificial intelligence prompting and implementation, blockchain development, cybersecurity, renewable energy installation, advanced manufacturing. Platforms offer bounties and freelance opportunities globally, allowing income in stablecoins or direct crypto payments that bypass banking frictions. Create intellectual property, courses, templates, software tools that generate passive revenue. The creator economy in 2026 rewards niche expertise delivered consistently. Build audiences slowly through value first content, monetize through subscriptions or one time products. Compounding here mirrors financial investing. Early effort establishes distribution that scales exponentially. Location arbitrage adds another layer. Cost of living disparities between regions remain extreme, and remote work untethers earning potential from geography. Relocate to jurisdictions with lower taxes, better incentives for innovation, or stronger property rights. Some countries actively court digital nomads and crypto holders with favorable visa programs and zero capital gains on certain assets. Research thoroughly. Stability, infrastructure, rule of law matter more than short term tax savings. Even within countries, moving from high cost urban centers to secondary cities or rural areas frees capital previously consumed by rent or mortgages. Redirect that capital into productive assets rather than lifestyle inflation. Risk management ties everything together. Never allocate more than you can afford to lose in volatile categories. Use position sizing based on conviction and volatility. Larger in battle tested assets, smaller in experimental ones. Maintain insurance where sensible. Health coverage to avoid catastrophic drawdowns, property protection for physical holdings, scenario plan for black swans, network outages, regulatory bans, prolonged bear markets. Diversification across custodians, jurisdictions, and asset types mitigates single points of failure. Regular reviews, quarterly at minimum, ensure alignment with evolving conditions. The psychological dimension cannot be overstated. Markets test resolve repeatedly. Corrections of 50% or more have occurred multiple times in crypto cycles, yet each recovery reached new highs for those who held or accumulated. Train the mind for asymmetry. Limit downside through research and sizing while allowing upside to run. Avoid leverage that amplifies losses. Consume information selectively, primary sources over sensational headlines. Journal decisions to learn from outcomes without emotional bias. Surround yourself with communities that reinforce discipline rather than hype. As digital control systems advance in 2026, the contrast sharpens. More payment apps integrate biometric requirements. More jurisdictions mandate reporting for crypto transactions above thresholds. More narratives portray self custody as risky or antisocial. These developments validate the sovereignty thesis rather than refute it. Alternatives exist precisely because centralized systems overreach. Privacy coins and mixing protocols evolve. Layer 2 solutions enhance scalability without sacrificing security. Decentralized identity emerges as counterweight to state IDs. The arms race favors open source innovation over closed bureaucracies. The men walking away ethos gains traction amid these tensions. It rejects participation in games rigged against new entrants. It declines roles that demand sacrifice without reciprocity. It withdraws consent from extractive institutions gradually but firmly. Energy previously spent seeking approval or fairness redirects toward creation and protection. Men, and increasingly women applying similar principles, build lives on their terms, relationships chosen for mutual growth, obligations accepted only when balanced, resources guarded for generational compounding. This is not retreat, but strategic advancement, and cultural signals in early 2026 reflect this awakening. Media narratives struggle to explain declining workforce participation rates among prime age males, framing it as laziness while ignoring eroded incentives. Birth rates continue trending lower in high cost regions as rational calculations prevail over societal pressure. Homeownership aspirations shift toward financial independence milestones instead. Travel, experiences, and freedom rank higher than status symbols for many. These shifts aggregate into powerful feedback loops. Less consumption reduces corporate power, lower tax bases pressure governments, declining dependency weakens control mechanisms. The endpoint is not collapse, but reconfiguration. Systems strain beyond capacity, adapt, or fragment. New equilibria emerge where value exchange occurs directly. Trust minimized through code and reputation. Wealth flows to those providing utility without intermediaries. Communities self organize around shared principles. The transition spans years, even decades, but early movers capture disproportionate gains. Positioned individuals mentor others, accelerating adoption. Networks compound faster than isolated efforts. Commitment today shapes outcomes tomorrow. Start with awareness, progress to action, sustain through discipline. Track metrics, net worth, income streams, skill mastery, health biomarkers. Celebrate progress incrementally, adjust without self recrimination. The path rewards consistency over intensity. When this early 2026 vantage point offers clarity unavailable in prior years. The trends are visible, the tools accessible, the choices binary. Dependency leads to managed decline. Sovereignty opens asymmetric upside. Choose the latter deliberately, execute relentlessly, and watch compounding work across dimensions. Let us consider the long term horizon beyond the immediate turbulence of 2026, because true sovereignty is not a sprint, but a marathon measured in decades of compounded decisions. As the year unfolds, economic data streams in confirming the trends we have tracked. Labor force participation rates in major economies remain below pre pandemic peaks, particularly among younger demographics who increasingly opt for alternative paths over traditional employment. Corporate earnings reports for the first quarter reveal margin compression from persistent input costs, with many firms passing increases directly to consumers rather than absorbing them. Government bond auctions draw softer demand at higher yields, signaling investor skepticism about fiscal trajectories. Pension funds disclose widening gaps between assets and liabilities, prompting quiet discussions of benefit adjustments that will fall disproportionately on future beneficiaries. These developments are not shocks. They are the logical extension of policies that prioritized short term stimulus and entitlement expansion over sustainable funding. The generation that designed and voted for these structures now transitions into drawdown phase, while the mechanisms to support them rely on a smaller, more burdened workforce operating under tighter monetary conditions. This reality accelerates the great reconfiguration already underway. Capital flows shift toward jurisdictions and assets that offer better alignments between risk and reward. Nations competing for talent and investment introduce targeted incentives, streamlined visas for high skilled remote workers, tax holidays for innovative enterprises, recognition of digital assets in financial frameworks. Individuals and families respond by voting with their feet, establishing residencies that optimize for freedom and opportunity. Digital nomad communities expand in regions with robust infrastructure and low regulatory friction. Expatriate networks share real time intelligence on banking stability, healthcare access, education options. This mobility is not elite privilege, but increasingly accessible through remote income and modest savings buffers. The internet democratizes information, making relocation planning feasible for those willing to research and execute. Within this migration, knowledge transfer becomes a force multiplier. Veterans of earlier cycles mentor newcomers through structured programs and informal channels. Forums dedicated to financial independence aggregate battle tested strategies. Tax optimization across borders, multi currency banking setups, international investment accounts. Cryptocurrency communities refine best practices for cross border transfers without intermediaries, using Lightning networks for instant settlement or privacy protocols for discretion. The collective intelligence compounds rapidly, reducing common pitfalls that once wrecked portfolios. Those who engage early gain years of advantage, building wealth, while others remain tethered to declining systems. The role of technology in this shift cannot be overstated. Artificial intelligence tools in 2026 enhance productivity dramatically for independent operators. Automated research, content generation, trading signals, administrative tasks, all handled with increasing sophistication at minimal cost. Individuals leverage these to compete with larger entities offering specialized services globally. Blockchain applications extend beyond finance into supply chain verification, intellectual property registration, decentralized governance. Smart contracts enforce agreements without courts or counterparties. The convergence creates an ecosystem where value flows directly between creators and consumers, bypassing extractive layers. Early adopters capture network effects as platforms mature and user bases grow exponentially. Health and longevity strategies gain prominence as economic pressures highlight the cost of dependency. Preventive medicine advances with wearable diagnostics, personalized nutrition via genetic testing, regenerative therapies becoming more accessible. Communities focused on biohacking share protocols for optimizing hormones, mitochondrial function, cognitive performance. The motivation is clear. Maintaining peak capacity extends earning years and reduces medical burdens in systems strained by demographic imbalances. Physical resilience translates directly to financial resilience. Fewer sick days, sharper decision making, longer compounding horizons. Family structures evolve in response to changed incentives. Multi generational households reemerge not out of necessity alone, but strategic alignment, pooling resources for collective advantage. Younger members contribute skills and income, while elders provide wisdom and childcare. Assets held communally appreciate together. Education shifts toward apprenticeship and self directed learning over credentialism, preparing children for fluid careers rather than obsolete ladders. Values transmission emphasizes sovereignty, critical thinking, practical skills. These units operate as mini economies, insulated from broader volatility while participating selectively in global opportunities. The psychological rewards of this path deepen over time. Freedom from financial anxiety liberates creativity and purpose. Relationships form on mutual respect rather than obligation. Time becomes the ultimate asset allocated to meaningful pursuits. Studies emerging in 2026 link higher life satisfaction to autonomy metrics, control over schedule, location, associations. The contrast sharpens against those remaining in traditional frameworks facing escalating costs, bureaucratic hurdles, surveillance integration. The sovereignty cohort reports lower stress biomarkers, stronger social bonds, greater generativity. Financial outcomes validate the approach quantitatively. Portfolios constructed around scarce assets and diversified income demonstrate superior risk adjusted returns through volatility. Bitcoin holders from earlier cycles achieve life changing wealth as institutional allocation reaches critical mass. Precious metals preserve purchasing power during currency stress periods. Productive businesses generate cash flow immune to market swings. Compound annual growth rates in the teens or higher become normalized for disciplined participants compared to low single digits in traditional retirement accounts eroded by fees and inflation. The gap widens annually, creating intergenerational wealth where none existed before. Regulatory responses in 2026 reflect establishment recognition of these shifts. Proposals emerge to tax unrealized gains, restrict capital outflows, mandate digital wallet integration. Narratives intensify portraying self reliance as antisocial or speculative gambling, yet enforcement capacity lags innovation velocity. Decentralized systems route around restrictions. Privacy technologies advance faster than surveillance. Jurisdictional competition prevents unified crackdowns. The attempts validate the thesis. When extraction becomes difficult voluntarily, coercion increases. This dynamic drives further disengagement, accelerating the parallel economy. Cultural expressions capture the zeitgeist. Media content celebrating independence proliferates. Documentaries on financial freedom journeys, podcasts interviewing sovereign builders, fiction depicting post dependency worlds. Mainstream outlets struggle to maintain relevance as audiences migrate to independent voices delivering unfiltered analysis. The Overton window shifts toward questioning sacred assumptions, entitlement sustainability, monetary orthodoxy, institutional infallibility. Public discourse polarizes productively, clarifying choices rather than obfuscating them. The ultimate vision is balanced abundance achieved through alignment, resources directed toward creation rather than maintenance of failing structures, communities thriving on voluntary cooperation, individuals realizing potential unconstrained by artificial scarcity. This is not utopia, but realistic outcome of aggregated rational choices. History shows transitions favor adapters over resistors. Empires centralize until inefficiency forces decentralization. Power concentrates until distribution becomes inevitable. We stand at such an inflection with tools more powerful than any prior era. Commitment compounds across every domain. Daily habits shape weekly outcomes. Monthly progress builds annual leaps. Yearly consistency delivers decadal transformation. Track inputs rigorously. Reading hours, skill practice, network expansion, savings rate. Review quarterly with objectivity. Course correct without judgment. Celebrate milestones meaningfully. The process itself builds anti fragility, strengthening through stressors that break fragile systems. And as 2026 progresses, markers will confirm direction. Adoption metrics for decentralized finance cross new thresholds. Relocation statistics show net outflows from high control regions. Asset prices reflect flight to quality. Policy desperation manifests in increasingly intrusive measures. Those prepared observe calmly, adjusting positions while others react emotionally. The prepared compound advantage precisely when others capitulate. This message distills years of pattern recognition into actionable clarity. The old paradigm served its beneficiaries well, but reached exhaustion. The new paradigm rewards those building deliberately now. No permission required. No apology expected, only execution demanded. What did you think about all this? Do you see the same patterns playing out, or do you push back on any of it? Drop your thoughts in the comments. I read them all. Like the video if it gave you something to think about. Subscribe if you have not already. Share it if you know someone who needs this perspective. And just remember that all roads lead to MWA, men walking away and cheers.
Nothing says you care like crypto. Nothing can compare. Nothing says you care like crypto. Oh, nothing can compare to crypto.